Welcome to the deep dive. We're jumping into a topic today that, well, it might seem a bit complex at first glance, but it's absolutely key if you really want to get a handle on the financial world. Our focus today, futures trading, it's, often misunderstood, but incredibly powerful. We're going to navigate the source material you've sent over, try to cut through the jargon, and really pull out the important stuff, maybe some surprising facts too.
Yeah, absolutely. And our mission for this deep dive, it's pretty clear. We want to go beyond just what futures are. We need to explore why they matter, how they actually work day to day, and the profound ways they let us interact with financial markets. Your sources are going to be our guide here, helping us get, well, truly informed.
And it's amazing just how far back these ideas go, isn't it? Derivative, in like various forms, they've been around for ages. We're talking ancient texts. I mean, Kautilya's Arthashastra from way back 320 BC in India. It apparently described early versions of what we now call forwards contracts, really early stuff.
That history, it's so important. It shows the basic idea isn't new at all. At its core, a future is part of this bigger financial derivatives world. What that means is its value is, well, derived from something else, an underlying asset. And that asset, it could be almost anything, a stock, a bond, commodities like gold or oil, even currencies. It's not an investment on its own, really. It's a contract about an investment.
Okay, right. Let's try and unpack that then. Before we dive straight into futures, maybe we should start with their ancestor, the forwards contract. You could think of it as the most basic kind of derivative, often used to say, protect against prices suddenly moving against you, like a farmer wanting to lock in a price for their crops months before they're even harvested. That kind of thing.
Exactly. That's a classic use case. A simple forwards agreement is just a direct deal, person to person. We call it over-the-counter, or OTC. No middleman, no exchange. Two parties just, well, effectively shake hands on exchanging goods for cash. They agree on a specific price, a specific future date, quantity, price, delivery date. It's all fixed right up front in their private agreement.
Yeah, the source had a good example. ABC Jewelers agreeing with XYZ gold dealers. They agree to buy, 15 kilos of gold at 2,450 currency units per gram 3 months down the line. So comes the date, ABC expects to pay XYZ around $3.675 million for that gold. And the crucial thing, like you said, is both sides are obligated. They have to go through with it no matter what the gold price does between now and then.
And the thinking behind it is interesting. ABC Jewelers, they probably think gold prices will go up, so they want to lock in today's lower price, protect their costs. XYZ gold dealers, they're thinking the opposite. Maybe prices will fall, so they want to, cash in on what they see as a high price now. It really highlights how these deals are driven by opposing views, or at least different expectations about the future.
Right, so let's play out those scenarios for the gold deal. Scenario one, gold price shoots up, let's say 2,700 gram. ABC Jewelers saves a chunk of money, right? Talk about 380,000 currency units because they're buying gold that's now worth $4.05 million for the agreed $3.67 million.
Right. And XYZ, they lose that exact amount. They have to get the gold at the higher market price and sell it for less.
Ouch.
Okay, scenario two. Price drops, say down to 2050. Now ABC loses. About 595,000 currency units. They're forced to buy way above the current market price.
And XYZ. They gain that 595,000, a nice profit for them.
And scenario three, price stays exactly the same, 2450. Then, well, nothing happens. No gain, no loss for either side. The key thing here seems to be the buyer's gain is always the seller's loss and vice versa. It's a zero-sum game between just those two.
Absolutely. And when it's time to settle up on these forwards contracts, there are usually two ways. There's physical settlement. That means the actual gold, in this case, changes hands. XYZ gets the 15 kilos at whatever the market price is then and delivers it to ABC for that agreed $3.67 million. The other way is cash settlement. No gold moves. They just settle the difference in cash. If gold went to 2,700, XYZ would just pay ABC the 380,000 difference. Simpler in some ways. Okay, that sounds straightforward enough. But where's the catch? What are the risks with these forwards? Because they seem simple, but the source mentions some big downsides, like liquidity risk, finding someone who wants the exact opposite deal to you at the exact same time for the exact same amount. That sounds tough in the real world.
It really can be. You might even need an investment bank just to find a counterparty sometimes.
Right. And then there's the big one, default risk or counterparty risk. What if the other side just walks away. Like your gold example, if prices skyrocket, maybe XYZ just thinks, forget it, defaulting is cheaper than fulfilling this deal.
Exactly. And because these are private deals, there's no central referee, no regulator overseeing them. That lack of regulation can make defaulting seem, well, more tempting for the party facing a big loss. It creates a bit of a Wild West feel sometimes.
And finally, rigidity. Once you're in, you're in. Can't just change your mind halfway through if the market shifts or your view changes. You're stuck until the end date.
Yes, and it's precisely those disadvantages, the liquidity problem, the default risk, the lack of regulation, the inflexibility, that really pushed the financial world to come up with something better. And that something better was futures contracts. They were designed specifically to fix these problems.
Okay, so given all those risks we just talked about with forwards, the defaulting, the difficulty finding someone being locked in, the market clearly needed, well, an upgrade. And that upgrade, that really clever improvisation, is the futures contract. I like the analogy in the source. An old car gets you from A to B, basic function fulfilled. But a new car still gets you A to B, but adds safety features, airbags, seatbelts, makes the journey safer, more reliable. The basic idea is the same, but the structure around it is way better.
That's a great way to put it. Futures contracts keep the core idea agreeing on a future price, but they build in mechanisms to, well, practically eliminate those risks we saw in forwards. So how are they different? First, a futures contract's price mimics the underlying asset very closely. If you trade gold futures, the futures price will move right alongside the actual spot price of gold.
And unlike those tailor-made forwards deals, futures are standardized contracts. Meaning things like the quantity, the quality, the purity, they're all fixed, predetermined, not up for negotiation. So you can't just buy, say, 17 grams of gold futures. You trade in set amounts called lot sizes.
And critically, futures are tradable. This is huge. You're not locked in until the expiry date like with a forward. If your view changes or you want to cash in a profit or maybe cut a loss, you can easily sell your contract to someone else and get out of the position. That flexibility is a game changer.
Definitely. And here's another massive difference. Futures are highly regulated. These aren't just private agreements. They trade on a central exchange. Think of it like a big, organized, secure financial supermarket. And they're overseen by regulatory bodies, like SEBI in India or the CFTC in the US. This drastically cuts down the default risk because the exchange itself steps in and guarantees the trade.
Futures are also time-bound. Every contract has a specific expiry date. In India, for instance, it's usually the last Thursday of the month for many contracts. So your prediction about the price needs to actually happen before or on that date for that specific contract. And lastly, most futures, especially financial ones, are cash settled. This just makes things much simpler. Instead of arranging delivery of, say, tons of wheat or barrels of oil, you just exchange the cash difference based on the price movement.
Okay, so just to quickly sum up those key differences then. Forwards, over-the-counter private deals. Futures, traded on a regulated exchange. Forwards, customized. Futures, standardized. Forwards, high counterparty risk. Futures, virtually none, thanks to the exchange guarantee. Forwards, unregulated. Futures, highly regulated. Forwards, hard to transfer. Futures, easily tradable. Forwards, settlement can be physical or cash. Futures, mostly cash settled. Got it.
Perfect. Now, before we look at a practical example, just a couple of quick terms we need. We mentioned lot size. That's the minimum quantity you have to trade. Then there's contract value. That's just the lot size times the current futures price. So if a TCS futures contract has a lot size of 125 shares and the price is, say, 374.90, the contract value is about 296,862 currency units. And finally, margin. This is key. It's like a token advance or a good faith deposit. It's a percentage of the contract value that you need to put up with your broker just to enter the agreement. It's not the full amount, just a fraction to secure your side.
All right, let's put this into action then. The source uses Tata Consultancy Services, TCS Futures. Let's walk through that. Okay, picture this. It's mid-December 2014. TCS management comes out, sounds a bit cautious about revenue growth, and boom, the stock price drops. Over 3.6% in the regular stock market, the spot market. Now, as a trader, maybe I think, hold on, this is an overreaction. December is often slow for Indian IT anyway, holidays and all that. It's usually expected. So I see this dip not as bad news, but as a buying opportunity. I expect the price to bounce back. I've got a clear bullish view here.
Right. So with that bullish view, instead of just buying TCS shares on the spot market, the decision is made to buy TCS futures. And it's important to remember, like we said, the futures price tracks the spot price very closely. So in this scenario, both the spot price and the futures price were down initially, reflecting that cautious announcement. Maybe by slightly different amounts, which is normal, but moving together.
Okay, let's look at the details of that TCS futures contract. It's a stock future. Symbol, TCS. Expiry date, December 24th of 2014, that last Thursday of the month rule again. Lot size for TCS futures is 125 shares. And the contract value, you just multiply the lot size, 125 by the futures price, 203.74.90 a day, which gives you that roughly 296,862 currency units value for one contract.
And here's what happens almost instantly when you place that trade. First, margin validation. Your broker system checks. Have you got enough cash in your account to cover the required margin? If yes, proceed. If no, trade rejected. Second, counterparty search. The exchange's super fast matching engine finds someone selling TCS futures, someone with the opposite view to you. Third, digital sign-off. Essentially, you and the seller digitally agree to the terms, you're both bound to the contract. And fourth, margin block. The required margin amount is blocked in your trading account. It's earmarked for this trade.
And the amazing part is the speed, right? All of that validation, matching, sign-off, blocking funds happens in, what, seconds? Milliseconds sometimes.
Oh yeah, it's incredibly fast in modern markets.
So owning one lot of TCS futures means you've digitally agreed. I will buy 125 shares from someone at this price by expiry. If TCS goes up, you make money. If it goes down, you lose money.
Exactly. That profit or loss is transferred directly between you and the counterparty via the exchange.
Now, here's a really key feature. Exploiting a trading opportunity, or what the source calls squaring off. What if, say, the next day, TCS stock price does shoot up, maybe to 2,460 currency units? You don't have to wait until expiry on the 24th, do you?
Not at all. That's the beauty of tradability. If the price moves in your favor quickly, say to 2,460, you're sitting on a nice paper profit. In this case, about 85 currency units per share profit. On 125 shares, that's over 10,600 currency units. You can decide right then and there to lock it in.
And you do that by squaring off, which just means doing the opposite trade, right? Since you initially bought one lot, you now sell one lot.
Precisely. You offset your position. The risk gets transferred to whoever bought that lot from you. Your margin money is unblocked, returned to your available balance. And that profit or loss from the trade, it's calculated and settled into your account, usually by that same evening.
That ability to get in and out quickly, that's a huge part of why people trade futures, isn't it?
Definitely.
Yeah.
It offers enormous flexibility compared to being locked into a forward contract.
Okay, so this brings up a really fundamental question. Many listeners might be thinking this. If I think TCS is going up, why mess around with futures? Why not just buy the stock in the spot market?
That's a great question. And the answer really comes down to one word.
Yeah.
Leverage. Financial leverage.
Leverage, right. The source uses a real estate analogy. Your friend books a, say, 10 million currency unit apartment, puts down only 1 million as the initial payment, that's 10% margin. Then the property value goes up 25% to 12.5 million. His initial 1 million investment has generated a 2.5 million profit. That's a 250% return on his actual cash outlay.
Exactly. That's leverage in action, using a smaller amount of capital to control a much larger asset value.
So let's connect that back to TCS. Imagine you have 100,000 currency units to invest. Option 1, buy TCS stock in the spot market. Your 100K gets you maybe, 42 shares? If the price goes up, like in the example, your 100K becomes maybe 105,800. A decent 5.8% return in 9 days. Not bad.
Okay.
Option 2, use that 100K for TCS futures. Let's say the margin required is 14%. For one lot, worth 297K, you only need about 41,335 in margin. With your 100K capital, you could actually buy 2 lots. That's 250 shares worth of exposure. That would require about 82,670 in margin, still into your 100K. Now, if the price moves up the same amount, that leverage position could generate a profit of around 39,250 currency units. On your initial margin used, that's a massive 47% return in those same 9 days.
That's the power, that's the allure of futures for many traders, amplified returns.
But there's always a but, right?
Always. Leverage is famously a double-edged sword. It magnifies gains, yes, fantastically so when you're right. But it magnifies losses just as dramatically, just as quickly when you're wrong. This inherent risk actually forces a kind of discipline. You have to know when you're wrong and get out fast. Because with leverage, losses can wipe out your margin very quickly. The market doesn't give you much time.
And you can actually calculate your leverage, contract value divided by margin.
Yep. So in that TCS case, roughly 295,000 divided by 41,000 gives you leverage of about 7.14 times. Meaning every one currency unit in your account is controlling over 7 units worth of PCS stock via the futures contract.
And higher leverage means more risk.
Absolutely. If leverage was, say, 42 times, a tiny 2.3% price move against you could potentially wipe out your entire margin deposit. Very high stakes.
Okay. And the payoff. The source mentions futures are a linear payoff instrument. What does that mean?
It just means your profit or loss moves in direct proportion to the price change. If the price goes up by 10 points, you make X amount. If it goes up 20 points, you make 2X. Down 10 points, you lose Y. Down 20, you lose 2Y. If you plotted it on a graph against the price, it would just be a straight line sloping up for a long position or down for a short. Simple, direct relationship.
Got it. And this links back to that zero-sum game idea.
Exactly. In the futures market itself, money isn't really created or destroyed overall. It's transferred from the loser's pocket to the winner's pocket. Buyer's gain equals seller's loss. Real wealth generation in the broader economy happens when companies create value, when the underlying assets actually become worth more. Futures are more about speculating on or hedging against price movements. It's about the redistribution of existing capital and risk based on those predictions.
Right. So margins are obviously super important for this whole system to work.
Right.
Why exactly are they charged? We touched on it, but let's dig in. It's all about risk, right?
Yep.
Preventing defaults.
Precisely. Think back to the forwards market, that direct, unregulated deal. Default risk is a constant worry there. But in futures, trades go through the exchange, and the exchange guarantees settlement. They promise that the winner gets paid. How can they make such a promise? Two key mechanisms. One, they collect margins up front, like we discussed, that good faith deposit. And two, they perform mark-to-market, or M2M, adjustments every single day.
Okay, so that initial margin, the IM, you mentioned it has two parts, span and exposure.
Yeah. Think of span margin as the core requirement set by the exchange. It's calculated using complex algorithms. SPAN stands for Standard Portfolio Analysis of Risk, to cover the maximum likely loss over a day or two under normal market conditions. It's the main safety net. Exposure margin is an additional buffer, kind of like extra padding added by the broker or exchange on top of SPAN. It helps cover risks beyond what SPAN models, like potential M2M losses between calculations.
And this total IM, it changes daily because the futures price changes.
Yes, the contract value changes, so the margin, which is usually a percentage of that value, will also fluctuate slightly day by day.
Okay, now let's really get into mark-to-market M2M. You said it's genius. How does it work day to day?
It's essentially a daily accounting process. Instead of waiting until the contract expires to figure out who won and who lost overall, the exchange settles the profit or loss every single day. Let's use the Hindalco example from the source. Say you buy Hindalco futures at 165. Lot size is 2,000. Day one, Hindalco closes higher at 168.3. That's a profit of 3.3 per share times 2,000 shares, so 6,600 currency units. That 6,600 profit is credited to your trading account that evening, and importantly, your effective buy price for the next day's M2M calculation is reset to 168.3.
Ah, okay, so you realize a gain immediately.
Right. Day two, price closes even higher at 172.4. That's another 4.1 profit per share from the new base of 168.3. So 8,200 profit credited. Your buy price resets to 172.4.
What if it goes down?
Good question. Day three closes lower at 171.6. That's a loss of 0.8 per share from 172.4. So 1,600 currency units are debited from your account. Buy price resets to 171.6.
And so you close the position on day four.
Right. Day four, you square off, maybe at 170.1. That's another loss, 1.5 per share from 171.6. So 3,000 is debited. Now, if you add up all those daily M2M adjustments, plus 6,600, plus 8,200, 1,600, 3,000, that equals 10,200 profit, which is exactly the same as your overall profit. Selling price 170.1, initial buy price 165, 2,000 shares equals 10,200. The M2M just breaks down that total P&L into daily chunks.
Wow. Okay, so M2M isn't just bookkeeping. It's the core mechanism that stops big losses from accumulating day after day. It prevents one party from suddenly owing a huge amount at expiry, which drastically cuts the chance they'll just default.
Exactly. It kills that counterparty risk we saw in forwards,
Yeah.
and it connects directly back to margins. That span margin we talked about. It's often called the maintenance margin. If your account's cash balance after daily M2M losses are deducted falls below the span maintenance margin level, you get a margin call.
Which is basically the broker saying you need to deposit more money now.
Yes. To bring your balance back above the required maintenance level, if you don't deposit the funds promptly, the broker has the right, and often the obligation, to liquidate or force close your position to prevent further losses piling up. The source shows this with an HDFC Bank example, tracking the daily margin changes and M2M hits, showing exactly when a margin call would trigger. This combination, initial margin plus daily M2M settlements plus margin calls, it's, as the source says, virtually a foolproof method to ensure defaults don't bring down the system.
Okay, so margins are critical. M2M keeps things safe daily. But how do you, as a trader, figure out the actual margin needed for a specific trade, like, say, Idea Cellular Futures?
Well, you don't have to guess. Exchanges and brokers provide tools. The source highlights the Zero the Margin calculator as one example. You basically just go to the tool, select the exchange, like NSE, the product futures, and the specific contract symbol, like IDA. And boom, it tells you the span margin, the exposure margin, and the total initial margin I am required right now for that contract. Takes all the guesswork out.
Handy. Okay, let's talk about expiry. We know contracts have an end date.
Right. It's simply the last day that particular futures contract is valid and tradable. And it's crucial because, well, your prediction about where the price is going needs to actually happen by that date. If you expected a stock to rise, but it only does so the day after your futures contract expired, that contract didn't help you. Timing matters.
But the exchanges offer some flexibility here, don't they? They don't just have one contract expiring this month.
Correct. Typically, for most active underlyings, an exchange like the NSE will offer 3 contracts simultaneously. The near-month contract, also called the current month, let's say that's January 2015. The mid-month contract, the next one out, so February 2015. And the far month contract, the furthest one out, March 2015. This gives you options depending on how long you think your market view might take to play out.
And usually, the further out the expiry, the more expensive the contract.
That's the typical pattern for equity futures, yes. Far month usually costs a bit more than mid-month, which costs a bit more than the current month. It relates back to that cost of carry concept, essentially, the cost of holding the underlying asset or equivalent funds for that longer period. We'll touch on pricing formulas later.
So what happens when, say, the January contract reaches its expiry date? Does it just disappear?
Pretty much. The January contract ceases trading, it gets settled, and then the system introduces a new far month contract to keep 3 active contracts available. So February becomes the new current month, March becomes the mid-month, and a new April contract would be introduced as the far month.
And traders who want to maintain their position, they roll over.
Exactly. A trader who was long the January contract and still wants to be long would sell their expiring January contract and simultaneously buy the February contract. That's called rollover. They're rolling their position into the next month.
Okay. And this idea of trading different months leads to another strategy, calendar spreads.
Yes, this is where things get a bit more sophisticated, but it's a direct consequence of having multiple expiry months. A calendar spread involves simultaneously buying a futures contract for one month and selling a futures contract for a different month, but on the same underlying asset. For example, buying January Ferret Forge futures and selling February Ferret Forge futures at the same time.
Why would you do that? What's the point?
Well, think about the risk. If the price of Ferret Forge tanks, your long January position loses money. But your short February position makes money. The two largely offset each other in terms of the underlying price movement.
Ah, so you're not betting so much on the direction of Hard Forge itself, but more on the difference in price between the January and February contracts.
Precisely. You're trading the spread, the relationship between the two expiries. Your overall risk related to the underlying's price is dramatically reduced.
And if the risk is reduced, does that mean the margin is reduced too?
Bingo. That's the key benefit. The margin for buying or selling a single Parat Forge contract might be, say, 37,000 currency units. But because a calendar spread is a hedged position, one leg offsets the other, the combined margin required could be drastically lower. The source mentions around 7,200 currency units for the spread.
Wow, that's a huge difference, a big margin benefit, as the source calls it.
It is, because the system recognizes your risk is much lower when you hold offsetting positions like that.
Okay, so we know why margins are charge risk management, preventing defaults. But you mentioned earlier, what if you could somehow tell the system more about your trade, about your risk plan?
Exactly. The more information the risk management system, RMS, has about your intention specifically, how long you plan to hold the trade and where you plan to cut your losses, your stop loss, the clearer your risk appetite becomes to the system, and the payoff for providing that clarity. Often lower margins. Think of it like bulk buying. If you tell a TV seller, I'm buying 50 TVs and I'm paying cash today, they know the deal is certain, their risk is low, so they might give you a much better price per TV. Same principle applied to trading margins.
And how do you give the system this extra information? Through different product types.
Yes. When you place your futures order, you typically select a product type, which signals your intentions. The default is usually NRML, which stands for normal. This signals you might hold the trade overnight, maybe for days or weeks. Since the RMS doesn't know your exit plan or stop loss with NRML, it assumes the maximum potential duration risk and charges the full margin span plus exposure.
Okay, what else is there?
Then you have MIS, which means margin intraday square off. By choosing MIS, you're explicitly telling the system, this trade is only for today. I guarantee I will close it out before the market shuts, typically around 3:20 p.m. Because the risk is confined to just one trading session, the margin required for MIS is significantly lower than NRML.
Makes sense. Lower risk duration, lower margin. What about covered orders?
Yeah.
Yes.
CO, cover order, is also an intraday product, like MIS, but it adds another layer of information. You must specify a stop-loss price when you place the order. So now you're telling the RMS, this is intraday ND, here's maximum I'm willing to lose on this trade.
Huh.
With both duration risk and maximum loss defined, the system requires even less margin than MIS.
And bracket orders. BO.
BO, bracket orders, like an enhanced cover order. It's also intraday. But here, you specify three things. Your mandatory stop loss, a target price where you want to automatically take profit, and optionally, a trailing stop loss feature. Since it provides at least the same crucial risk information as a CO, intraday duration plus max loss, the margins for BO are usually similar to CO margins, very low compared to NRML.
And you can see these different margin levels using that margin calculator tool again.
Absolutely. The calculator typically shows you the NRML margin and the MIS margin side by side. You can quickly see, for example, with 80,000 currency units, how many lots of ACC cements you could trade using NRML overnight versus how many lots of Infosys you could trade using MIS intraday. The difference in buying power due to lower intraday margins can be substantial.
Okay, you mentioned trailing stop loss with bracket orders. That sounds interesting. How does that work?
It's a really neat technique, actually. It helps you protect profits you've already made and potentially ride a trend for even bigger gains. Well, imagine you buy Infosys futures at 21.75 and you set your initial stop loss at 21.50, a 25-point risk. Now, let's say Infosys moves up 15 points to 21.90. A trailing stop loss can be set to automatically move your stop loss up by that same amount. So your stop loss would automatically adjust from 21.50 up to 21.65, still 25 points below the current price, or maybe a fixed amount like 15 points, depending on settings.
So now you've locked in a minimum profit of, you've reduced your potential loss. If it drops back, you only lose 10 points instead of 25 from your entry, or if you trail tighter.
Exactly. Or if the price keeps going up, say to 2,200, your stop might trail up to 21.80. Now, if it falls back, you're stopped out, but with a guaranteed 5-point profit locked in. It stops profits from turning back into losses and lets you stay in a winning trade longer, automatically adjusting the safety net upwards as the price moves favorably.
Let's switch gears a bit. Shorting, selling first, buying later. It sounds backward.
It does feel counterintuitive at first.
Why would anyone do it?
Simple reason. You believe the price of something is going to go down. You want to profit from that decline.
The source uses a betting analogy, like betting on your team to lose a match.
Exactly. If you bet India will lose the cricket match, and they do lose, you win your bet. You were short India. In markets, being short means you profit if the price falls.
Okay, so how does it work practically? Let's say shorting HCL Technologies stock in the spot market at 1990.
Right. You initiate the short sale at 1990. If the price drops to your target, say 1950, you then buy back the shares. You sold high, bought low, profit. 40 currency units per share.
And if it goes against you, hits your stop loss at 2000.
You still have to buy it back. You buy it 2000, sold at 1990, bought it 2000. Loss, 10 currency units per share.
But there's a big catch with shorting stocks in the spot market, right? The intraday rule.
A huge catch. Short selling actual shares in the spot market is strictly intraday in many markets, including India. You must buy back those shares before the market closes that same day.
What if you don't or can't?
That leads to what's called short delivery. The exchange was expecting you to deliver shares that you borrowed to sell, but you didn't buy them back. This results in an auction process and potentially very heavy penalties. The source mentions penalties up to 20% above the price you shorted at. It can be extremely costly.
And this is precisely why futures are so useful for short sellers.
Exactly. This is a major advantage of futures. When you short a futures contract, there is generally no intraday restriction. You can hold a short futures position overnight for days or weeks, just like a long position, waiting for your bearish view to play out. Much more flexibility.
And the margin calculations, the M2M, it all works the same way for short positions as for long ones.
Yep, identical process. If you're short and the price goes down, good for you. your account gets credited daily via M2M. If the price goes up, bad for you, your account gets debited daily. Margins are required just the same. The mechanics don't change based on direction.
So shorting isn't some niche weird strategy. It's fundamental to active trading, just as important to understand as going long.
Absolutely critical. You need to be comfortable playing both sides of the market if you want to trade actively.
Okay, let's talk about a specific contract that's hugely popular, especially in India. Nifty futures. The source says it's one of the top 10 index futures traded globally. That's big.
It really is. Nifty Futures, as the name suggests, gets its value directly from the Nifty 50 index that benchmark tracking India's top 50 large companies. It's highly standardized. The current lot size is 25 units, so if the Nifty index is at, say, 86,631, the contract value of one Nifty Futures lot is 800,631 times 25, which is about 215,775 currency units. And the margins are relatively low compared to single stocks. Maybe around 17,300 for NRML overnight, but significantly less for intraday MIS, around 7,000, or BOCO around 6,200.
That low margin likely contributes to its popularity. And this brings us to liquidity. What exactly is it, and why does it matter so much, especially for something like Nifty futures?
Liquidity is simply how easy it is to buy or sell an asset quickly without causing a big price change just by your own trading. Think of it like water in a pool. A deep, liquid pool, like Nifty futures, can absorb a big splash, a large trade, without the water level changing much. A shallow, illiquid pool, like a rarely traded small stock, even a small splash, causes big ripples and changes the water level significantly. High liquidity means you can usually get your trades filled easily, at or very close to the price you see quoted.
And we can measure this with something called impact cost.
Yes, impact cost is a way to quantify liquidity. It basically measures the cost of doing an immediate round-trip trade. That means buying at the very best available selling price, the ask, and immediately selling back at the very best available buying price, the bid. The difference between those two prices, the spread, represents the cost you incur just for the immediacy of trading.
The source compares MRF, an illiquid stock, with Nifty futures.
Right. For MRF, doing that instant round trip might cost you, say, 98.7 currency units, representing an impact cost of maybe 0.3%. That's considered very high. It costs a lot just to get in and out quickly. For highly liquid Nifty futures, that same round trip might only cost 1.1 currency units, an impact cost of maybe 0.0125%, much, much lower.
So the gap, the spread between the best buy price and the best sell price that you see on your screen, that's a direct indicator of liquidity and impact cost.
Pretty much, yes. A narrow spread means high liquidity, low impact cost. A wide spread means low liquidity, high impact cost.
Which implies that hitting the market order button in a really illiquid stock is probably a bad idea.
Yeah.
You could get filled at a much worse price than you expected because of that wide spread.
Generally, yes. Using limit orders where you specify your price is often safer in illiquid markets.
Okay, so why else does trading Nifty make sense for so many people? Liquidity is one big reason.
Several reasons. First, it's inherently diversified. Trading Nifty is like trading a basket of 50 top stocks. This automatically eliminates most of that unsystematic risk, the risk tied to one specific company having problems. Research suggests holding around 21 diverse stocks significantly reduces unsystematic risk. Nifty gives you 50. So you're mainly left with systematic risk, the overall market risk.
And it's hard to manipulate, right? Harder than a single small stock.
Much harder. It reflects the broad market sentiment. It requires enormous capital to push the Nifty index significantly.
We mentioned highly liquid easy fills, low impact cost, lesser margins than most individual stocks.
Right. It also allows you to take a broader economic call. It's often easier to form an opinion on the overall economy or market direction than on the fate of one specific company.
Plus, technical analysis chart patterns, indicators, they tend to work better on highly liquid instruments like Nifty futures, where price action is smoother and reflects collective psychology more accurately.
And finally, it's generally less volatile. The Nifty index might have an annualized volatility of, say, 16-17%. A single stock, like Infosys, could easily be 30% or more. Smoother ride, relatively speaking.
Okay, let's dive a bit deeper into the mechanics now. The futures pricing formula. This sounds a bit mathy. Do traders really need to calculate this all the time?
Not necessarily calculate it manually every day, no. But understanding the concept behind it, often called spot future parity, is really important, especially if you're interested in strategies like calendar spreads or arbitrage. Essentially, the fair price for a futures contract isn't arbitrary. It's mathematically linked to the current spot price of the underlying asset. The formula is basically futures price, spot price, 1 plus risk-free interest rate, time to expiry 365 days, any expected dividends before expiry. Think of it as the futures price should equal the spot price plus the cost of carrying that asset until expiry, interest costs, minus any benefit you'd miss out on by not holding the spot asset dividends.
So using the emphasis example again, if spot is 2280.5, maybe 7 days left, risk-free rate is X, the formula might spit out a fair value for the future of, say, 2283, but the actual market price might be slightly different, like 2284. Why?
Tiny differences are normal. Market frictions, transaction costs, temporary supply-demand imbalances can cause the actual market price to deviate slightly from the pure theoretical fair value. And generally, the further away the expiry date, the more days X is in the formula, the bigger the difference between the spot price and the fair futures price, simply because the cost of carry interest accumulates over more days.
Okay, and when the futures price is higher than the spot price, that's called trading at a premium, or a contango in commodities.
Correct. That's the normal state for assets with a positive cost of carry, like stocks where interest cost outweighs dividends.
And if futures are trading cheaper than spot, that's a discount. Or backwardation.
Yes.
Yes.
That can happen sometimes, maybe due to high demand for the immediate physical asset, or unusual dividend situations, or specific commodity market dynamics like storage costs.
And the source shows that nifty graph. Futures consistently trade at a premium to the spot index.
Almost always, yes.
But crucially, as expiry day approaches, those two lines, spot and future, they converge. They meet exactly on the final day.
Always. They have to. On the expiry day, the futures contract becomes the spot asset, or its cash equivalent, so their prices must be identical at settlement. That convergence is guaranteed.
And this guaranteed convergence is what allows for strategies like cash and carry arbitrage.
Precisely. Arbitrage looks for situations where the market price of the future is significantly out of line with its theoretical fair value, creating a risk-free profit opportunity. For instance, if Wipro spot is 653, but its futures contract is trading way up at 700, when the fair value calculation says the spread should only be maybe 5 points, that's a 47-point mispricing.
So what do? The rule is buy cheap, sell expensive.
Exactly. In this case, the future is expensive, 700, relative to its fair value based on the spot. 653 plus 5 equals 658. The spot is cheap. So the arbitrager would simultaneously sell the overpriced futures contract and buy the underlying Wipro stock in the spot market.
And because they know the 47-point spread will eventually narrow down to the fair 5 points, or 0 at expiry, they've locked in a profit.
Yes. The source shows a P&L table. No matter where Wipro's price ends up at expiry, higher, lower, or the same, the profit from that initial spread difference is locked in because the convergence will happen. It's exploiting a temporary market inefficiency.
And calendar spreads, which we mentioned earlier, are sort of an extension of this, creating the spread between two different futures expiries of the same asset.
Kind of, yes. You're still playing on the relative pricing between contracts, often related to the cost of carry or changing market expectations over different time horizons. Like selling the current month Wipro future and buying the mid-month Wipro future. Again, because it's a hedged position, long one month, short another, the margins are significantly reduced.
All right, let's shift to perhaps one of the most practical, widespread uses of futures. Hedging. The source uses a nice analogy. Building a fence or a literal hedge around your garden.
I like that one too.
You build the fence not to make money from the fence itself, but to protect your valuable garden, your investments, from things that could damage it, like stray cows or market downturns.
It fits perfectly. Your carefully built stock portfolio is the garden. Those sudden, sharp market sell-offs or turbulent periods are the stray cows. And using futures contracts to protect your portfolio's value during those times, that's erecting the protective fence. It's about risk management, pure and simple, protecting what you have.
So why hedge? What are the alternatives if you think the market's going to fall? Option 1, do nothing, just ride it out. But if your portfolio drops 25%, from 100 down to 75, it needs to gain back 33.33% just to break even again. That's a steep climb.
The math of losses hurts.
Option 2, sell everything, go to cash, and try to buy back lower. But that means timing the market perfectly, twice, which is notoriously hard. Plus, selling incurs taxes, fees.
Very difficult to pull off consistently.
Option 3, hedge. The source says hedging insulates your position, making you almost indifferent to what really happens in the market for that period, like a vaccine shot for your portfolio.
It aims to neutralize the market's impact on your portfolio's value, yes. You offset potential losses in your stocks with potential gains in your hedge.
Okay, we need to understand the types of risk first. Unsystematic and systematic.
Right. Unsystematic risk is company-specific stuff. A particular company's revenues disappoint, their CEO gets into trouble, a factory burns down. Bad news for that company. But this kind of risk can be diversified away. If you hold a basket of different stocks, like the 21 Plus mentioned, the bad news from one company is likely offset by neutral or good news from others. Your overall portfolio isn't sunk by one firm's problem.
Okay, so diversification handles company-specific risk. What about systematic risk?
Systematic risk is the big picture stuff, market-wide risk. Things like a slowing economy, GDP drops, rising interest rates across the board, wars, pandemics, major political shifts. These things tend to affect almost all stocks to some degree. You cannot diversify this risk away just by holding more stocks because the whole market is moving.
For sure.
You can hedge it. Exactly. Systematic risk can't be diversified, but it can be hedged, often using broad market instruments like index futures.
So just to be clear, we diversified to reduce unsystematic risk, and we hedged to reduce systematic risk. Two different tools for two different types of risk.
Perfectly put.
How do you hedge a single stock then? Say I own 250 shares of Infosys Spot at $22.84, and I'm worried about a market drop.
Simplest way is to short the equivalent futures contract. You're long 250 shares in the spot market. So you go short 2 lots of Infosys futures, assuming a lot size of 125, maybe at a price of $22.85. Now, if Infosys price drops, your spot shares lose value, but your short futures position gains value. If the price rises, your spot shares gain, but your short futures lose. Ideally, the gains and losses offset each other, making your overall position market neutral. You're protected from the price movement, up or down. A truly perfect hedge happens when the value of your spot holding exactly matches the value of your futures position.
Okay, that makes sense for a stock like Infosys that has futures contracts. But what if I own a stock that doesn't have futures? Or maybe I only own, say, 50 shares, which is less than a full futures lot. Can I still hedge?
Good questions. And this is where beta comes into play.
Beta.
Right.
That measures how much a stock moves relative to the overall market.
Exactly. It measures the sensitivity or volatility of a stock compared to a benchmark index like the Nifty or Sensex. By definition, the market index itself always has a beta of +1. A stock with a beta less than 1, say 0.7, tends to move in the same direction as the market, but less dramatically. It's considered less risky than the market. A stock with a beta greater than 1, say 1.5, also moves with the market, but more dramatically. It's more volatile, more risky than the market average. And a beta less than 0, rare for stocks, more common for other assets, means it tends to move in the opposite direction to the market.
So how does beta help us hedge a whole portfolio, especially one with stocks that don't have individual futures? We use Nifty futures.
Precisely. You use Nifty futures, or another broad index future, to hedge the overall systematic risk of your entire portfolio. Here's how. Step 1. Calculate your portfolio beta. This isn't just averaging the betas of your stocks. You need to calculate a weighted average. For each stock, multiply its individual beta by the percentage weight that stock has in your total portfolio value. Then sum up all those weighted betas. The source gives an example portfolio with a calculated beta of 1.223. This means the portfolio is expected to be about 22.3% more volatile than the Nifty index itself.
Okay, got the portfolio beta. Step 2.
Step 2. Calculate the hedge value. This is the total value of your portfolio multiplied by your portfolio beta. So if your portfolio is worth 800,000 currency units and its beta is 1.223, the hedge value is 800,000, 1.223 equals 978,400 currency units. This is the Nifty equivalent exposure you need to offset.
Right. And step 3, find out how many Nifty lots to short.
Yep. Step 3, calculate the number of lots. Divide your hedge value by the current contract value of one Nifty futures lot. So 978,400 divided by, let's say, 225,625 Nifty value lot size equals about 4.33.
But here's the problem again. You can't trade 4.33 lots. You have to trade whole lots, right? 4 or 5.
Exactly. That's the practical challenge. You'll always be slightly underhedged if you short 4 lots, or slightly overhedged if you short 5 lots. Achieving a mathematically perfect hedge with futures is often impossible due to these fixed lot sizes.
But even an imperfect hedge is better than no hedge.
Generally, yes. If Nifty drops 5.5%, as in the example being short 4 Nifty lots, might generate a profit of, say, 54,125 currency units. Your portfolio, with its beta of 1.223, would be expected to lose about 5.5%. 1.2238 100,000 equals roughly 54,035 currency units. So the hedge gain almost perfectly offsets the portfolio loss, achieving that near neutrality despite being slightly underhedged. It works quite well.
And this answers the earlier questions too, right? You can hedge a stock without its own futures by calculating its beta and including it in your portfolio hedge calculation using Nifty futures.
Correct.
And for very small positions, less than a nifty lot value. Futures might be too blunt an instrument, but maybe options could work.
Options often provide more granularity for hedging smaller positions or achieving more precise hedge ratios, but that's definitely a topic for another deep dive.
Okay, let's wrap up with one final concept. Open interest, OI. Sounds important, but how is it different from just volume?
They're related but distinct, and OI gives you a different kind of insight. Open interest OI tells you the total number of futures contracts or options contracts that are currently outstanding, meaning still open and not yet closed out or expired. Remember, every trade needs a buyer long and a seller short to create a contract. OI counts the total number of these open contracts existing in the market at any given time. If someone opens a brand new position, a new buyer meets a new seller, OI increases by 1. If someone closes an existing position, or an existing long sells to an existing short who is covering, OI decreases by 1. But if an existing long sells their contract to a new buyer, OI doesn't change. The contract just changed hands, it didn't get closed out.
The source example helps clarify this. Arjun buys one lot from Neha, new buyer, new seller. OI goes up by 1. Barun buys one lot from John, new buyer, new seller. OI goes up by 1 again. Now OI is 2. But then Arjun, existing long, sells his lot to Vikram, new entrant. OI stays at 2?
Correct, because one open contract was simply transferred. It wasn't newly created or destroyed overall. Understanding how OI changes based on whether new participants are entering or existing ones are leaving is key.
Okay, so how does that compare to volume?
Volume is much simpler. It just counts the total number of contracts traded during a specific period, usually one day. Every time one contract changes hands, 1 buy plus 1 sell matched, volume increases by 1. Volume tells you about the activity level on a given day. It resets to 0 every morning. OI, on the other hand, is a cumulative number. It tells you about the level of commitment or the total number of active bets currently placed in the market for that contract. It carries over from day to day.
So volume is like the number of transactions today. OI is like the total number of positions still open from all past transactions.
That's a good way to think about it.
And on their own, maybe they don't tell you much. But together with price.
Exactly. That's where the real insight comes from. Looking at how price, volume, and open interest are changing together gives you clues about the market's underlying strength or weakness and potential sentiment shifts.
The source has that interpretation matrix. Let's run through it.
Okay. Scenario 1. Price is up and OI is up. This is generally considered bullish. It suggests new money is coming into the market, initiating new long positions, and supporting the price rise. Strong underlying trend.
Scenario 2. Price is down and OI is down. This often suggests a weakening bearish trend. People who were already long are likely closing out their positions, selling, causing OI to fall. This covering might indicate the downtrend is losing steam, potentially setting up for a reversal.
Scenario 3. Price is down and OI is up. This is typically seen as bearish. New money is entering, but it's initiating new short positions, adding pressure to the downside, and suggesting the downtrend has conviction behind it.
And scenario 4. Price is up and OI is down. This can signal a weakening bullish trend. The price rise might be driven by existing short sellers covering their positions, buying back, which reduces OI. Lack of new long positions suggests the rally might be running out of fuel, possibly leading to a reversal.
It's a framework for interpretation, not a crystal ball, but very useful.
One important warning, though. Be cautious about abnormally high OI combined with sharp price moves.
Yes, extremely high OI, especially after a rapid price run-up or run-down, can indicate excessive speculation and leverage. It suggests the market is crowded on one side of the trade. This makes it very vulnerable. Even a small piece of counter news can trigger panic selling or buying if short, leading to sharp or volatile reversals as everyone rushes for the exit at once. High OI can sometimes signal peak euphoria or peak pessimism.
Wow. Okay, we have covered a lot of ground today. A real deep dive into futures. From those ancient concepts in India to modern hedging strategies, standardization, M2M. We've really unpacked how these instruments are designed, not just for speculation, but crucially for managing risk, using leverage carefully, and offering incredible flexibility.
Absolutely. And the key takeaway should be that futures are incredibly powerful tools. They aren't inherently good or bad, but they demand understanding. When you grasp the principles shared risk, guaranteed settlement via margins and M2M, the transfer of obligations, leverage, you can see how they profoundly shape financial markets.
So maybe the next time you hear about big market moves or commodities swinging wildly, think beyond the headline. Ask yourself, how might futures contracts be influencing that flow of money, that perception of risk? What stands out to you, listening now, about how these tools empower but also challenge traders and investors?
And remember, these ideas aren't confined to stocks. Leverage, hedging, standardized contracts, expiry. These concepts apply across commodities, currencies, interest rates. It's a universal financial language in many ways.
Well, thank you for joining us on this really comprehensive deep dive today. Until next time, keep learning, keep asking those questions, and keep exploring.